As the 30-year fixed mortgage rate hovers around 7%, a lot of buyers are getting desperate and looking for more creative mortgages to purchase a home. But are some of these mortgages a little bit too risky, and it seems like we're repeating what happened in 2007 and 2008? Or are these mortgages ways to fix the affordability issue going on in this country? In today's video, we're going to discuss these mortgages. We're going to talk about what they are, the pros and cons, and if you should really consider these different loan products. Make sure you all like this video and subscribe for some more awesome content around real estate, personal finance, and the economy as a whole. The first mortgage I want to highlight is called the Community Affordable Loan Solution. This is a mortgage product by Bank of America that allowed their borrowers to purchase a home with no credit pull, no money down, no mortgage insurance, and zero closing costs. Instead of pulling their credit and looking at that number, that credit score, Bank of America states that they're going to pull other factors to determine eligibility. According to Bank of America, they will instead look at if a potential client has been paying their rent on time, their utility bills, and phone and insurance payments. Now, in order to qualify for this loan, you do have to meet a certain income level and live in a certain specific area, because this loan product is geared more towards low income families and especially people of color. And so it is designed more for minorities such as Blacks and Hispanics, but anyone, any race can still qualify for this loan. So this loan product obviously rolled out in places of high minority growth or populations where there's a large group of people of color, such as Detroit, Dallas, and Charlotte. Now, to start with some drawbacks of this loan product, obviously the number one is that there's no specific credit pull. Yeah, and people who have no experience with credit, you have to be hesitant to giving them like such a large asset, such a large loan like they do college age students. They give them $40,000, $50,000 loans. These 18-year-olds do not know what they're doing. And I think giving someone a house, giving them something that's $100,000, $200,000 worth of debt to their name, I think in a way you're setting them up for pre-foreclosure. And we already know like this loan is geared towards people of color, and pre-foreclosures and foreclosures are already super high. So I don't see how this loan can specifically help them. I see where they're going, but I think it could be really tricky and you have to be careful with it. Whenever I hear a loan and it says no down payment, no credit score, and different things like that, it just echoes the sentiments of what happened in 04, 05, 06. And I think loan products like this can just motivate us to repeat history of what happened back in the day with the housing crash. Now, this loan product does offer some educational resources, but they're essentially just some PDFs that they probably just send to the potential client. But how many of these clients will actually read these PDFs? And how many of them actually know it's not only your mortgage payment, but now you have utility bills that are higher than what you were paying for at an apartment, most likely because it's a bigger house, or just maintenance requests and repairs that you have to pay for. That's all on you as a homeowner. A lot of people don't have that education. And so just giving them PDFs, I don't think it's enough. Maybe requiring a class or something like that might be a little bit more beneficial. Now, I do appreciate their effort to offer a loan product because, yes, there is a history with people back in the day of color not being able to qualify for loans. But yeah, times have definitely changed. I'm a homeowner. The percentage of people of color with homes is still drastically lower than people who are not of color. And so I think, yes, offering a product just to put that in people's mind. And yeah, I even talked to family members, and a lot of people do not understand that they can buy a house. Like something simple, like maybe that's always been talked about in your home, in your family, but in some communities, especially lower class communities, whether you're Black or white or Asian, whatever, like they don't even understand that concept that they can own their house. And I think that's very important for people to understand that. The next mortgage loan product I want to talk about addresses the interest rate issue that's been going on, or essentially the higher interest rate, and they're trying to attack that very issue. Honestly, buying a house around an interest rate of 7% can be a little bit daunting, especially if you're coming from a home that has an interest rate below 4%. And that's where the assumable mortgage comes in. The assumable mortgage is essentially you assuming the mortgage and the terms of that mortgage from the seller. So if you're buying a house from a seller that has a 3% interest rate, all you can do is just transfer your name into that mortgage loan that seller has, and now you have that 3% mortgage instead of the current rate of around 7%. Now, one thing you have to consider, you have to make sure the seller's mortgage loan product is an assumable or can be assumable. Not every loan product is assumable. One drawback to this loan is obviously that you have to bring up the cash or some sort of secondary financing in order to pay off the equity of that home. So for example, let's say you see a house and it costs $100,000. And the seller, the person you're buying the home from, still owes, let's say, $60,000 on that property, but you agree to buy their house for $100,000. So yes, you can assume that loan of $60,000, and let's say it's a 3% interest rate. That's great. But now you have to come up with $40,000 in cash in order to completely fulfill that purchase of $100,000. And that's a 40% down payment, right? And not everyone has that type of income. So a lot of people either get secondary financing or get a loan off that $40,000. That's just something you have to consider when you're assuming a mortgage. The other thing with this loan you have to consider is that, once again, not all loans qualify for an assumable mortgage. There are some rules behind FHA and VA loans. And if you're a VA and you have a loan that you want to give to someone else, so someone else assumes your loan, you cannot go out and use the VA loan until that current loan is paid off. So essentially, you can't use the VA loan twice, or like you can't use two VA loans at the same time, if that makes sense. Because someone can't assume your VA loan and then you go out and you try to buy a house with a VA loan. So a lot of veterans, I don't see them allowing people to assume their loan because they want to use that benefit as a veteran. The final product that I want to talk about is the adjustable rate mortgage that has been on the rise recently. The number of applications for the adjustable rate mortgage is at its highest level since 2008. And its current interest rate sits between 6 and 6.3% at the time of this recording. Essentially, an adjustable rate mortgage is a lower interest rate that you pay than a 30-year fixed mortgage, but you only pay that lower interest rate for the first 5 to 7 years, depending on the terms of the loan. So for example, the current 30-year fixed mortgage, let's say it's at 7%, you can get an adjustable rate mortgage around 6%, which is 1% lower, and you pay that interest rate for the first 5 years of that loan. And once those first 5 years are gone, it changes back to the current 30-year fixed rate at that time. So you can kind of see the drawback in that. You're trying to predict the future that rates are going to be lower than what they are now. And we can't predict the future. That is very difficult. So you run that risk of rates being actually higher than what they are now. I personally would stay clear of these mortgages because these mortgages were super popular back in 07, 06, 05 when the housing market crashed. And I believe I was reading online, it took a third of all mortgage applications were adjustable rate mortgages. And if the interest rates do go lower, you can always just take your fixed mortgage and refinance to the lower interest rate. And that's essentially it. Like, you don't have to do all these things. What are your thoughts? I would like to know down below in the comments, what are your thoughts on the different mortgages that are happening around the country lately? Which ones do you 100% disagree with? Which ones are you considering? and which ones do you think would work for like an investment loan or for a primary residency? I am interested in like the assumable rate mortgage or the assumable one, only if I don't have to pay off the equity. It's similar to like a sub 2 deal. A sub 2 is a investing type of strategy where you take hold of someone's mortgage, but a lot of times maybe you do put a little bit of money down, but you don't have to put your name under their mortgage. There's not as much paperwork or anything like that. But yeah, that's a common practice in the investing real estate world. All right, you all, hope you all enjoyed this video. Make sure you like, subscribe, comment down below, and I'll talk to you all later.